In November 2023, the global asset giant Vanguard Group withdrew from China's public RMB fund market. In October 2023, Citibank sold its personal wealth management business in mainland China. In September 2023, the world's largest asset management group, BlackRock, closed its China Flexible Wealth Fund. In the same month, the world's second-largest sovereign wealth fund, the Norway Sovereign Wealth Fund, announced the closure of its Shanghai office. In September 2023, Canada's largest pension fund, CPP Investments, exited its transactions in China. According to statistics published by China's Banking and Insurance Regulatory Commission, since records began in 2007, up to early September 2022, 329 foreign commercial banks applied for exit, with a peak starting in 2016. From 2016 to 2021, a total of 252 foreign financial institutions exited. In the first 3 quarters of 2022, 19 exited and only 7 were newly established. This trend is continuing. Let's take a closer look at the specifics. Global asset giant and America's largest capital aircraft carrier, Vanguard Group, officially exits the Chinese market. According to a Bloomberg report on November 2, 2023, Vanguard Group, one of America's largest fund management companies, is taking the final steps to exit China. The news of Vanguard's withdrawal from China has drawn widespread attention. Insiders reveal that the group has signed dismissal agreements with about 10 remaining employees in Shanghai, most of whom will leave early next year, and the office will close. In October 2023, Vanguard sold its 49% stake in a robo-advisory joint venture with Ant Group, but will continue to provide support until the end of the year for a smooth transition. The report stated that Vanguard is changing its strategy and leaving China, a market once considered to have great potential as the second largest market in the world. In fact, many foreign financial institutions had already started withdrawing before its announcement. One of the world's largest asset management groups, BlackRock, closes its China Flexible Wealth Fund. On September 5, 2023, BlackRock, the world's largest asset management company, announced in an open letter to shareholders that its BlackRock Global Fund would close its sub-fund, the BGF China Flexible Equity Fund. BlackRock stated in response to media inquiries that the fund would be closed from November 7th, attributing the liquidation to routine management of the fund and emphasizing the protection of investors' interests. The world's second-largest sovereign wealth fund, the Norway Sovereign Wealth Fund, closes its Shanghai office. Managing $1.4 trillion, the Norway Sovereign Wealth Fund, the world's second-largest sovereign wealth fund, announced on September 7, 2023, the closure of its Shanghai office, which is down to only 8 employees at the moment. The institution stated that the decision to close the Shanghai office was made for operational considerations, with its Asia Operations Center moving to Singapore. Over the years, the fund's Singapore office has gradually become the hub for the entire Asian region, assuming all operational functions, including those for China. As of the end of 2022, the Norwegian Sovereign Fund invested in about 850 Chinese companies, with a total investment of $42 billion. Canada's largest pension fund, CPP Investments, exit transactions in China. According to a Voice of America report on September 7, 2023, CPP Investments, Canada's largest pension fund, has laid off at least 5 investment professionals at its Hong Kong office as it exits transactions in China. The managing director in charge of the company's Greater China real estate investment portfolio was informed weeks earlier that his position would be made redundant. According to the fund's latest annual report, its net assets amount to 570 billion Canadian dollars, with a 10-year nominal net return rate of 10%. In terms of its investment proportions in different regions, the United States accounts for the largest share at 36%, followed by Asia Pacific at 26%. The significant decline in the fund's annualized 5-year net return in the Asia Pacific region is mainly due to the negative impact of China's COVID-19 zero-case policy on the economy. Apart from CPP Investments, other Canadian pension funds are also withdrawing from China. According to Reuters, the Ontario Teachers' Pension Plan, OTPP, disbanded its China equity investment team in Hong Kong in April this year. Additionally, the Financial Times reported on June 1st that CDPQ, Canada's second-largest pension fund, has stopped private transactions in China and will close its Shanghai office later this year. Furthermore, the Financial Times reported in February that Singapore's Sovereign Wealth Fund, GIC, also reduced its private investments in China. Citibank sells personal wealth management businesses in mainland China. On October 9, 2023, Citibank announced the sale of its personal wealth management business in mainland China to HSBC. The deal covers Citibank China's personal wealth management customer investments and personal deposits in 11 major cities on the mainland, amounting to approximately $3.6 billion as of August 2023. Concurrently, Citibank is downsizing its personal wealth management business globally. As early as April 2021, Citibank announced a global strategy adjustment, exiting personal banking services in more than a dozen markets, including mainland China. Major global investment banks in China see significant profit declines, over half loss-making in 2022. According to a Financial Times report in May 2023, profits of Western investment banks like Goldman Sachs and Morgan Stanley in China dropped significantly last year. The causes were COVID-19 lockdowns and geopolitical tensions, which dashed the bank's hopes of finally becoming profitable in China. Data revealed by the banks and seen by the Financial Times showed that Credit Suisse, Deutsche Bank, Goldman Sachs, and HSBC reported losses in China for 2022, while profits at Morgan Stanley declined. Among the 7 Wall Street groups and 1 European group with investment banking divisions in mainland China, only JP Morgan Chase and UBS Group saw profit increases, and HSBC's losses were lower than in previous years. In December 2022, after the Chinese government ended the 3-year dynamic zero-COVID policy, some foreign investors were initially optimistic about the Chinese market, resulting in rapid inflows of foreign investment in the first few months of the year. However, this recovery quickly lost momentum due to escalating US-China geopolitical tensions, increasingly strict regulations and restrictions on foreign investments by the Chinese government, and China's own economic downturn and political risks. These factors contributed to the exodus of the aforementioned financial and investment institutions from the Chinese market. An American think tank analyzing the characteristic of the global financial crisis in 1988, the Asian financial crisis in 1998, and the U.S. financial crisis in 2008 summarized 10 signs of an impending financial crisis. 1. Stock market crash. 2. Large-scale capital flight. 3. Banking credit crisis. 4. Significant rise in corporate debt defaults. 5. Serious asset price bubbles. 6. Large reductions in official foreign exchange reserves. 7. Severe overall economic downturn. 8. High corporate or household debt-to-asset ratios. 9. Sharp decline in corporate profits or household income growth rates. 10. Major national disasters. Experts believe that if 3 or more of these signs are met, it indicates an imminent financial crisis. If 6 or more are met, it suggests that an economic crisis has already arrived. Looking at China's current overall economic situation, almost all these signs are met. The reason for the non-full-scale outbreak is mainly the Chinese government's suppression of information and administrative intervention. However, this suppression is only temporary and may increase the scope and severity of the financial crisis when it erupts. In fact, the US-China trade war that began in June 2018 was the trigger for systemic financial risks in communist China. The subsequent 3-year pandemic and the Chinese government's brutal zero-COVID policy, along with this year's collective default of real estate developers led by Vanguard Group, officially unveiled the systemic financial risks in communist China. The Federal Reserve's consecutive interest hikes in September led to defaults on dollar debts by several Chinese real estate companies. The arrest of Evergrande Group's boss, Xu Jiayin, signaled the complete bursting of the real estate bubble. The Chinese stock market once again fell below the critical support of 3,000 points, and the 3 engines driving the Chinese economy, investment, consumption, export, all stalled. The 4 markets, real estate, stock, bond, and foreign exchange, are all in decline, marking the full outbreak of China's financial crisis. Moreover, bad bank debts and local government debts, the 2 financial nuclear bombs that are bigger than the real estate sector, are still yet to explode. Even with the limited economic data released by the Chinese government, the dire state of China's current economic situation is still evident. Data recently released by China's State Administration of Foreign Exchange shows a net negative foreign investment in China of $11.8 billion in the 3rd quarter of this year. This is the first time since China's accession to the WTO that a negative value has been recorded. This indicates that the situation of net outflow of foreign corporate funds is extremely severe, a stark contrast to the previous year's quarterly investments of several tens of billions of US dollars. According to the latest data released by the General Administration of Customs in China, In October 2023, China's goods exports amounted to $272 billion, down 8.9% compared to $298 billion in the same period last year. Goods imports were $218 billion, up from 2.3% from $213 billion last year. The net goods export of $54 billion is a significant drop of 37% compared to $85 billion last year. This decline suggests a dramatic decrease in China's net goods export. The current trend indicates that China's trade surplus might soon revert to the 2018 level of $300 billion. Deducting the annual service trade deficit of over $200 billion and the outflow of foreign capital in the investment sector, the trade surplus could rapidly turn to zero or even into negative. The latest data from the National Bureau of Statistics of China shows that in October 2023, the Consumer Price Index, CPI, fell by 0.2% year-on-year, indicating that China's economy has re-entered a deflationary level following a 0.3% drop in July. Additionally, the Producer Price Index, PPI, declined by 2.6% year-on-year, marking the 13th consecutive month of decrease. The Industrial Producer Purchase Price Index fell by 3.7% year-on-year. From January to October, the average PPI was down 3.1% compared to the same period last year. Taiwanese macroeconomist Wu Jialong commented on the situation.
The withdrawal of substantial funds from China reflects a loss of confidence in the Chinese market. Concerns about strict Chinese regulations, including the anti-espionage law and foreign exemption law, are making foreign businesses apprehensive about operating in China due to both commercial and personal safety concerns. So foreign businesses think to themselves, forget waiting any longer, let's just leave quickly. Now it's a race to see who can leave first.
Recent revelations regarding a chairman of investment banking from Japan's Nomura International being barred by Chinese authorities from leaving mainland China further confirmed the long-standing concerns in the industry. Sources reveal that the banker, a seasoned Hong Kong financier named Charles Zhonghe Wang, joined Nomura's China investment banking division in 2018 and served as its chairman. Previously, from 2011 to 2016, he worked at China's state-owned bank, Industrial and Commercial Bank of China, ICBC. The Chinese government's prohibition on his departure may be related to a prolonged investigation into Bao Fan, a top Chinese technology dealmaker who had connections with someone who worked at the same division as Wang when he was at ICBC International. The introduction of China's anti-espionage law has not only led to record sell-offs of mainland Chinese stocks by foreign institutions, but also accelerated their withdrawal from the Hong Kong stock market. As the business environment continually deteriorates, it's not only foreign financial institutions that are affected. Gallup, a globally renowned performance management consulting company, has also shut all its mainland Chinese offices and exited the Chinese market amid the stagnant Chinese economy and rapidly intensifying national security scrutiny. Previously, American consulting firms had been actively seeking business in China, but the severe economic downturn in the country has further intensified the scrutiny of the consulting industry by Chinese national security agencies, fearing that data sharing with foreign enterprises might jeopardize national security. Gallup became a target of Beijing authorities due to its global opinion polls showing a decline in foreigners' favorable views of China. The Chinese state media Global Times claimed that Gallup's opinion polls are tools for containing China and maintaining U.S. dominance. A Gallup poll in March this year showed that Americans' favorability towards China had fallen 15%, reaching a historic low. The Global Times editorial stated that opinion polls have become a tool manipulated by American political elites to discredit China on the international stage. As Gallup exits China, other multinational consulting firms are also reducing their operations in the country. Forrester Research, a consultancy focused on technology, has significantly cut its China-based analysts. Gerson Lehrman Group, GLG, initially planning to expand its China operations this year, began reducing its staff in China from the summer. Major American blue-chip consulting firms have offered paid leave or delayed new employee start dates to prevent consultant overstaffing. Taiwanese macroeconomist Wu Jialong believes that
the first point is the business environment in China, especially as the domestic economic situation itself is deteriorating. A lot of data is being withheld from publication, creating a lack of confidence and security among everyone. The second point is that doing business in China now involves the risks to personal safety and commercial operations, making it nearly impossible to continue operating without a sense of security. The domestic market in China itself is not what it used to be. It is now contracting. Business is indeed becoming more difficult, leading foreign investors whether direct or indirect, to withdraw from the Chinese market.
Regarding the Chinese government's increasingly opaque practices in publishing corporate and economic data, Søren Andal, founder of the renowned short-selling firm Blue Orca Capital, recently stated,
China is turning into a complete black hole of investment information. All that's going to do is drive investors away from China.
Andal mainly refers to the Beijing authorities' increasingly frequent restrictions on foreign businesses obtaining local economic data. He emphasizes the ways of obtaining data in China have undergone significant changes. Andal notes that Blue Orca Capital has drastically reduced its research time on Chinese stocks listed in Hong Kong and the US from nearly 70% to less than 10%. The reasons include increased difficulty in obtaining data and declining market valuations. He points out that Chinese companies in 2010 used to publish detailed financial data, but now investors can only access basic indicators like revenue, assets, liabilities, and net profit. Moreover, Chinese officials no longer publish lists of the most profitable companies at the provincial or city level. Notably, China has stopped releasing real-time data on youth unemployment rates and mutual fund net asset values. Regarding China's current economic situation, international opinions and investment institutions are generally pessimistic. The Wall Street Journal claimed in an article in September that the Chinese stock market is a scam mill, leading to a collapse in confidence among millions of stock investors. Morgan Stanley has continuously downgraded the rating of China's A-share market and publicly urged investors to stay away from this market, perceived to be rife with fraud. Swiss Julius Baer also stated that the A-shares have no investment value, while Goldman Sachs released a report bearish on Chinese state-owned banks, and Moody's downgraded the outlook for China's real estate industry to negative. In September, Reuters pointed out in an article titled, "Part of China's economic miracle was a mirage. Reality check is next," that China proposed 60 reform tasks at the third plenum of the 18th Central Committee of the Communist Party in 2014, aimed at fixing an outdated growth model more suitable for a developing country. However, most of these reforms have not progressed, and the economy largely depends on old policies that have exacerbated China's large debt and industrial overcapacity. William Hurst, a scholar at the University of Cambridge who studies China's development, stated, "Things always decline slowly until they suddenly collapse." He believes that in the short term, there is a significant risk of a financial crisis or economic crisis of some degree, which would bring substantial social and political costs to the Chinese government. Eventually, there must be a reckoning. The pandemic, population decline, and geopolitical tensions have exacerbated all problems to the extent that even if China reopens, the economy is unlikely to recover this year. A crisis could erupt at any moment if the massive real estate market collapses in an uncontrolled state, dragging down the financial sector. Another high-risk explosion point is local government debt, estimated by the International Monetary Fund, IMF, to be as high as $9 trillion US. Logan Wright, a partner at Rhodium Group, stated,
Crisis is going to occur in China when government credibility falters, when all of a sudden funding is cut off for the remaining investments that seem subject to market risk. That's a huge moment of uncertainty in China's financial markets.